Hey, this is Sasha Evdokov, and welcome to another episode of Let's Talk Stocks, episode number 98. And in this episode, we're going to be going over reading the stock market trading conditions, or in other words, the road conditions in the market. And it's important for you to know these road conditions or market conditions in the stock market because you're looking at evaluating and understanding the environment. You're understanding how that driving is happening, what's ahead, what are the risks, what are the factors that are ahead. And that way you know whether you should pull over and take a little bit of a break or breather. Let's just say there's a storm outside or there's major rain, or go ahead and continue driving, go ahead and continue pushing, or go ahead and continue investing. So that's kind of what we're going to cover. And with understanding the conditions, you'll learn whether you should be buying more, selling, or holding, or shorting a stock. So there's a couple of different factors to really hone in on this lesson. And this topic is really in depth. I could probably create a good 6-hour session about this topic, if not even longer, because there's just so many factors. But you'll get a little bit of a taste here, and maybe it'll open up your eyes a little bit, and then you go ahead and apply it and study things a little bit more on your own. So my goal here for you is to take this session and just really expand upon it. Now, the lesson is probably going to be less than 40 minutes long, because that's usually my goal, and that's usually what I try to keep it under. So we'll try to expand that into the lesson, and most of the things that I'm going to be covering here, it'll take that 30, 40 minutes, but normally as I'm trading and as I'm doing things, really I look and evaluate these conditions all within less than a minute, less than probably within 10 seconds of looking at a chart. And that is simply because I've seen the other conditions and past conditions, and I've also have been familiar with yesterday's market action and market conditions. So that's really what it comes down to. And as you get more familiar with the market and as you follow it more, you'll become quicker and better at it. But as you put these things into practice, then it may take you a little bit longer. So be patient, do your nightly homework, and then, apply that to the stock charts you're watching and looking at. So in today's video session, things are a little bit different. You might be able to now see me on screen because we have a webcam here. I have a broadcasting checker over here on this monitor. I have my charting software over here on the bottom, and then there's just a few other audio software over here that's happening. So I wanted to go ahead and try something like this with a green screen, so that way I can share with you more knowledge and information or share with you examples. I think it makes things a little bit more better in terms of a connection level, because I'm always looking how to improve my education, how to help transform the idea over to you, because in the end, I'm sending you the ideas, the concepts, and you have to decode it. So for me to go ahead and send more data, more information your way, whether that's just using hand signals, if you're able to get more knowledge and information out of it, if you're able to digest the lesson a little bit better, then by all means, I would go ahead and use it. So it's all about learning and taking your education to the next level. So if this helps you, this type of format helps you, then go ahead, give me a thumbs up, and I know that I should continue making more videos in this kind of format. If you don't like it, feel free, give me a thumbs down, and that way I also know. Now, my goal and plan really is in the future to go ahead and do this type of format for more webinars and streaming things in the future. So we'll see how it goes and how well you like it, and that way I know whether we should try this in other formats or not. Now, I've already had this video crash a couple of times, so hopefully this time it actually goes through and records properly, because there's a lot of things that are going on and happening, and it's also my first time doing it. So with that being said, let's go ahead. Let me know if you like it, if you don't like it as well. That way I know whether I should continue doing these lessons. But let's go into the lesson here and go through some of these conditions on the trading conditions. So here I have a few of my notes. As far as the trading conditions that we have, one of them being time, another one being external factors, and then internal factors. Now, those are just some of the big ones that I want to cover, and there's subcategories within those, but I really want to dig deeper into the stock chart themselves. But just as a quick little summary or rundown or synopsis, when you have time conditions, you have as you're driving, you basically have, daytime driving, nighttime driving, afternoon driving, midnight driving. So there's a lot of different types of time conditions that you have, similar in the market, which we'll get into in a second. Then you also have like rush hour driving, during a lot of traffic time. So again, time type of condition. Then you also have external conditions like weather conditions. And when you have weather conditions or construction and road conditions, you might have debris on the road. You might have rain, hail, storms, cloudy, sunny. So all these different things are referred to external. And then you also have internal conditions. And internal conditions are all about the way that you're feeling. As you're driving, you might feel angry, pissed off. You might feel happy. You might feel joyous. All these different things might really come inside of you. And when you have these types of feelings, it affects your driving. Some people who are more angry, they might drive a little more aggressive, and that could affect you. And with trading, same thing. So we're going to look at those kind of concepts as far as trading goes and as far as the charts go. So let's take a look at the chart here, and let's just pick any chart. I'm going to go ahead with Amazon for the time being. Just because it's a popular company, I might switch around from time to time. But in either case, let's look at the time condition here. And again, I'm just going to go through this fairly quickly because it's a very in-depth topic and subject, and I'm trying to cover a great deal. So on the time frame, when I'm looking at stock charts on a time frame, I'm looking at multiple time frames. Notice here, there's a 2014 year. Okay, I'm looking over here. There's a 2015. It's off screen. But this is the weekly chart. I like looking at the weekly chart because it gives me a little bit of a bigger picture. It gives me a flyby view of the chart. I don't really look at these hourly charts or 30-minute charts. I will if I'm active and I'm looking at the other screens over here, how the stock is moving for that day. But my decision making comes typically from the daily chart and then also analysis with the weekly chart. Now, I put them all together, but this is the time condition that you want to be aware of. When you're looking at this in terms of time, understand that the daily plays more of an important role than, let's say, the 30-minute or the 10-minute or the 15-minute. The daily is more important. And the reason it's more important is because you have bigger, heavier support and resistance lines. There's more people out there on the roadways. There's more people trading at those time frames. And when they're trading at those time frames, you have support, stability, and you have resistance from overhead that pushes down. So looking at the daily and the weekly really gives you a nice flyby view of the chart. Now, if you go to a little bit of a bigger picture, the monthly can also do some really good views for you. I typically don't look at the quarterly. Sometimes I will, but typically the monthly would be almost the widest I go out. And when I look at the monthly, it also gives me another perspective. It gives me, okay, where are we now in the market? How far extended are we on the big scope of the picture? Okay, so those are some things that I really look at as I'm making my trading decisions is what's the time frame? And if you're driving, if you're looking, to have a little road trip, and when you get up really, really early, then you might get a lot less people out there on the road. Or the same thing if you're driving really late at night, let's say 3 o'clock in the morning. There might be more favorable conditions for you. So you're looking at the charts. As you're looking at the charts, you're looking at what's favorable, what are the conditions, what's the time frame telling me? Am I really extended on the upper end? So if you have a really far extended stock, okay, as far as timing goes, might not be the best time to enter the stock, okay? And that is simply because you're looking at those conditions as far as how far stretched things are. Just like we know and understand that a stock has a rubber band effect, well, you're looking at the same thing here. How far stretched is this? And if I look at the monthly, I would be a little more cautious on this stock to really jump into it. And that is simply because it's just so far stretched and the timing might not be the best if you're looking at the monthly. If we're looking more on the weekly here, the weekly might look still a bit stretched because we're still at the upper end. And if we're looking a little bit at the daily, now you could say, okay, well, we're kind of looking at a light little pullback over the last week. Okay, and we're coming into this moving average support line. So you can see the stock's kind of moving at the support line level. So that's what I have now in the back of my head. So as I'm now looking at this chart to think about my trading decision, of course, I'm thinking, what's my risk? But in the back of my head, what's my timing? What's my timing in terms of the month? Okay, if I'm looking at the monthly chart, my timing for the monthly chart is not really the best. It's not really at a value play. It's not like a descending trend line kind of over here, and then the stock breaks out. Okay, so the timing is not the best, okay, as far as the monthly goes. Then I look at maybe the weekly, and then again, the weekly could tell me, okay, I'm kind of there, but, it's still not the greatest. And then I look at the daily. The daily says a little bit better. We're coming into the support. So if I'm holding this or planning to hold this for a short little period of time, that might be okay. But, I have to have those other conditions in the back of my head as well. And that to me creates a little bit more of a risk problem. And that is why in this case, I probably would not take the trade, because I'm now looking at that timing. The conditions of me getting into this chart or getting into the stock are not really that favorable or amazing. Now, sometimes I may take on a trade, but then if I do, looking at a chart like this, I will go much lighter. Okay, I go a lot less shares. So if, let's say, you normally trade 1,000 shares, I might only trade, let's say, 100 shares on this one. If you're trading, let's say, 100 shares normally, you might only put on 10 shares on this one. And that is simply because the weekly and the monthly overall don't feel good to me. Typically, I like buying on these. If a stock is coming back, let's say, to this price level on July 2016 here, we're on July 19th. If it comes back to these price levels and then I see a bounce, that might be a nice opportunity to buy some more shares if you're value buying. But if you're, buying at upper levels without a strategy, the timing is probably not the best. So you have to look and understand, okay, where is that timing? And that's why for many people, if you're looking at just a 15-minute chart, you're going to get whipped around, okay? You're going to get whipped around on these 10-minute charts, on these 5-minute charts, because your timing, you're only looking at a very short time frame. Whereas everybody else, there's millions of other traders, they're at different price points and at different times. They might be sick of the trade, they might be ready to cash out. So by you knowing and understanding the time that it takes to get somewhere, the time that it takes for the stock to move, the time that is appropriate for you to get in, when's the best time? So when is the best time for you to travel if you're traveling on a trip? It's probably not during the holiday season because everybody else is traveling. You don't want to travel during the holiday because all the plane tickets are more expensive. All the planes are booked. Sometimes you can't get reservations. It's just more headaches. It's a little more crowded. You can't really go and see all the things that you want because things just get booked up. It's not the best timing. And here in the stock market, you're looking the same thing. You're evaluating multiple time frames to see when's the best condition. Now, if you have multiple things lining up, if you got the daily lining up, if you got the weekly chart lining up, if you got the monthly chart lining up, if everything is telling you that this stock is ready to go, okay, if it's lining up perfectly, then you go. Then that's the time you buy. But if things are not lining up, then there's no way that you trade the stock. So looking at this stock, when were things lining up? So if I looked at here, the monthly, there's a couple places I'm looking at already. There's some over here. Now, the prices are a little bit stretched. You might want to go to a log chart right there, and that kind of cleans things up a little bit, but we'll do arithmetic still, and that way you can see. But you might have a little bit thing right here that's lining up in 2010. You also have for a longer term investing right here, 2014, 2015, descending trend line. And then as you go into the weekly, you can see this descending trend line right here, and then it breaks. And it breaks on what? What do I always talk about? The volume. And it breaks out. And if you missed it right there, what you could have done really is draw a line across. You can see you had a little consolidation pattern. You draw that line across, and even if you went to the highs in 2014, you can see right there, the stock lined up perfectly. And that was your perfect timing. Now, in the market, there's nothing really perfect. I mean, I say perfect timing, but that's more ideal. So even if you missed that one, you had another opportunity here, a little consolidation pattern, a little better timing, and the stock broke a little bit higher. So you could have went in that time frame. Or again, you had another little opportunity a little bit later. So you're always looking at these little patterns of how they're created within the monthly chart, then the weekly. And if I split to a daily, you can see how that really works out exactly the same way. So maybe on this April, May, June, let's just zoom in on here. Back here, there was the break. There's the volume. You can see it. Okay, so maybe right here you wouldn't have gotten in May, and that is simply because of a large gap up, but the stock here pulled back into that level and it held the support, and that would have been your opportunity because it's holding those price levels. And then again, you had another opportunity breaking higher, and if you look at the volume, if I stretch the volume, look at the volume right here, how big it is coming into the stock. So again, looking at timing right there really helps out. And if you have those things in your favor, multiple conditions, more power to you. Then you got everything in alignment and it's all working. And that just really works out really well. So looking at timing is the number one condition that I wanted to discuss. And of course, you could look at the timing as far as the time of the day to trade, such as morning, afternoon, or later towards the evening session. But that is on a day-to-day, shorter-term basis. In general, looking at these bigger scopes, if you have the bigger time frame correct, then by all means, you can go ahead almost at any time. For example, if you're going on a trip and you're trying to hit low season, as long as you're in low season depending on which country you're going, whether it's the southern hemisphere or the northern hemisphere, but if you're hitting something between January and March, it's probably lower peak season here in the northern hemisphere. So it really doesn't matter if you go in February or March. Same thing here. It doesn't matter if you go tomorrow, the next day, or the day after, if you have the timing kind of proper. But if you're going, during the summer months when everybody else wants to go, now you're trying to time on a shorter time basis, whereas, okay, maybe I go on a Monday to Friday on my vacation because there's less people, or maybe people are working during, the weekdays. And, so those are things you might be considering. But again, here with the timing, if you have kind of the good range, you don't have to worry about, hitting a precise day to get that timing correct. Similar to how some people, they spend Christmas and they do their Christmas gifts actually after Christmas. They do it after January 1st to time the discounts and sales with all the retailers. It's kind of a weird dynamic, but it works, and you're timing it a lot better, so you get a lot more savings. Now, in either case, the next kind of condition that I want to talk about are the external conditions, or kind of the weather conditions, the road conditions. So as you're looking at this stock, there's other things and factors that you have to take a look at. So the same thing with the market. As we look into the market, you're looking at multiple factors and conditions. Like, for example, right now we have the interest rate thing that's going on and that's happening. The Fed is basically scared to raise interest rates. So we have these conditions that are happening. We also have global conditions that are happening. So like we have negative interest rates with Japan and many other countries. We have banks that are kind of in that defaulting stage. We have countries in that defaulting stage. So we're in a weird dynamic condition as far as the global economy. So you start looking at that and you say, okay, so should we be making all-time highs on a relative basis? How great is unemployment relative to the past? How great is the economy relative to the past? And that's the thing, is that the market doesn't always move based on the economy. It moves based on perception of things and based on fear and greed, supply and demand, right? So with this in mind, if you have the Federal Reserve, just like right now we have the Fed not wanting to raise interest rates, they're a little bit scared, they have that fear in them, then the market is not going to be that scary, because they believe, the traders believe that, well, if they're not going to raise rates, if they're too scared, the economy is not in a good, in that great of a position. by all means, they're going to prop it up. They might do more quantitative easing. They might go ahead and pump more money into the system. So we just continue to inflate prices further and further because the Fed has your back. Because what happens is with these Federal Reserve boards, with a lot of these things is, nobody, it's like a hot potato. Nobody wants to be the one that says we're going to go to interest rates 5%, within the next year, and you start raising interest rates every couple of months and you get to that price level. Because if you did that, there would be a lot of people in a panic state. A lot of people, the economy wouldn't be stimulated. People wouldn't spend money as much. You wouldn't buy those brand new cars. But that also means, a lot of people would have to make do with what they have. And I think actually that's a good thing, because a lot of people are overextended on their credit lines. And that's what happens, though, is when the Fed has your back and when nobody wants to raise interest rates because they don't want to be the one to raise interest rates and have the economy or the stock market collapse, because now you have people's retirements in your hands and things like that. So they're trying to keep it propped up. They're trying to keep it stable. And this happens with a lot of the bailouts that happened. This is what they do, is they prop markets up. That's why markets typically go up rather than down. But when they sell off in a big, big way. They sell off faster than they push higher. So in this case, when you have these markets being propped up, you're looking at the external conditions. So this external conditions, is it rainy? Is it sunny? Is it cloudy? Is it, is there a storm happening? What's going on in the market? And for us right now, if you're looking at the market conditions, things are being propped up. I wouldn't say it's sunny, but it's kind of, in a way, if you're driving and it's sunny, it's probably not the best condition. If it's a little cloudy, I like driving in cloudy conditions because the sun isn't hitting you. It's not hot on your side or that side of your body, depending on where the sun is. And, if it's not raining, it's a lot better. Cloudy driving to me is just a lot better way to drive. But ideally, what's happening now with the markets is what they're doing is they're creating and giving you sunglasses when it's really sunny or when it's really stormy. Or if it's, storming, like there's a lot of snow happening, your windshield wipers are going crazy, but it's still stormy outside, so you still have to be careful. So what they're doing right now is they're really propping up these markets, and they're kind of taping, a little sunshine to your mirror or visor, or they're taping, they're giving you some sunglasses. So, hey, here's some sunglasses. So deal with it. It's fine. Everything's good to go. So by all means, keep trading, keep buying stocks. So that's what's happening. And when I look at the global economy, being here at all-time highs, when you have negative interest rates, when you have, company earnings down, the way these companies are hitting the earnings is they're cutting jobs. Just take a look. They're cutting jobs, and by cutting jobs, it allows the profits to be a little bit better. They can make and hit their earnings targets. Or the other thing that they do is they ship more products earlier. So, for example, one company may ship more products to another company in this quarter, so it might be okay in this quarter, and then they'll deal with the next quarter later, even though that may hurt them in the next quarter, because now that next company that they deal business with has a bigger supply of those products and services that they didn't really need that month. But that's what they do. They go ahead and ship things earlier. All the big corporations do that, but it's kind of manipulated. So even though some things may seem better and rosy, you have to remember to take the rose-colored glasses off and see the bigger picture. So here I'm looking at those external conditions. Are there things on the roadway? Are there hazards? What's going on with the economy? What's the Fed doing? Are they scared? Are they panicking? Are they moving and treading slowly? And then, you're looking at all these things, and you kind of still have all these factors in the back of your mind about the bigger term view, the bigger picture. When was the last time you had a major pullback? A major one like 2009. You take a look here in 2009 or in 2000. Okay, when was the last time you had a major pullback? You haven't had it for a while. And now we're over here coming in all-time highs. Can the market go higher? And if I look at it, is it likely for it to get to 3,000 very soon? Imagine a market getting back up to 3,000. to me, I'd be a little nervous considering, from the year 2000, getting all the way up to 3,000 right there without a major pullback. I'd say it'd be a little bit dangerous and a little bit stretched. I'd love it to get back to 1550 over here if I'm looking at the bigger picture, to bounce off of that 1550 and then go higher. That would be more real. That would be more healthy. And, you can make money trading to the upside, downside. It creates better charts. It allows you to create more opportunities. So I'm really always looking for those pullbacks because they give you more opportunities. Here, when the market's barely moving or trading, if you look at the VIX, and I'm looking at the volatility index at 11, if it barely moves around, professionals don't like this because the market doesn't move. You're not really making a lot of money. You might be able to make some money from dividends and time decay of option premiums, but you're not really making great money on the price movement. So it's a lot better when the market's moving around because you're able to take some things into account and buy at lower prices, like here on the Brexit dip and stock markets pop, or here in the January-February dip and stock markets pop. So looking at evaluating these external conditions, you start taking that into account, and then you add the timing to it, and now you start looking at your decision. Do I buy? Do I sell? Do I hold? And again, or do you kind of trade very lightly? If you're the person that needs to be in the market, for me, I'm very active in the market. I wouldn't say I'm a day trader because I don't trade every single day. But, I might put on 4 or 5 trades a week, no problem. I might put on 15 or 20 trades a week if the conditions are right, okay? So it really depends. And certain conditions, I may only do 1 or 2 trades because it's a little bit more concerning. And in conditions like this, where the market hasn't really done much, if I look at it right here, it's really just kind of moving slightly sideways right here, but kind of to the upside in a very, very tight range, and that is because of the VIX. If you look at the Bollinger Bands, okay, and you look at the daily Bollinger Bands, you can see how we were much more volatile or spread out, which these take into account the price spread of the bars. So as you can see right up here, there was a bigger, larger spread, whereas compared to where we are currently, it's a lot tighter, which means the price movement is going to be a lot weaker. So during these cases, I'm just sitting. I'm sitting around I have positions, but I'm not trading as actively because what do you do? What do you get into? It's going to move, 5 cents, 10 cents. I'd much rather take my time and, enjoy myself, go do a craft project, go, record another video like the videos for our sessions and training educational sessions, or even write a book. So, it's much more favorable. And then once the market picks up or you have a nice little down day, then you can go ahead into those conditions and it's favorable. The volatility picks up and it's like, all right, well, now things are actually going to move a bit. So you're evaluating these conditions and you're starting to be aware of what's happening based on all these factors. So we have the time is the first condition. Then after the time, you're looking at the external conditions. Like here you have the global economy, the Fed, the dollar, all these things, the defaults, the interest rates, all those things you're taking into account. And you start putting these things together. So you got this thing plus this thing. And now what's next? What's the next thing I look at? And the next thing I look at is how I'm doing during the day, the week, or the month. Okay. Typically, my emotions are very controlled in the market. I've kind of balanced out that way due to, in part, the martial arts, due to, in part, just my natural behavior or my personality. I've been very mellow, and that's just the way I am. When I look at the market, the other thing you always need to consider and be aware of is how you are personally, internally. Are you more antsy? Are you the person that's right now feeling, I got to make some money because I need to, buy some groceries, or I got to make some money because I want to get a new camera? Or, if you have this feeling, then chances are you're going to put yourself in a much riskier position, in a much more dangerous position. So those are some things you really need to be aware of. Sometimes if you're trading angry, if you're trading with a high degree of greed, if you really need the money, if you're in a fearful state, you're really scared because you lost a lot in another trade and now you're trying to make it back. These are all internal emotions, similar to how we talked about external conditions. Now you got these internal conditions that also will be affected in your account. So when we're talking about looking at the stock market conditions and your trading conditions, this is all part of it. You have those external conditions, you have these internal conditions, you have the timing, and of course there's other conditions and factors that'll creep in, but ideally you want to be in a content and well-being state. Not to where, if you go to your favorite restaurant, not to the point where you're like, the steak or the sushi or, whatever it is that you like or enjoy. You're not at that stage. You're more of like, okay, I'm at dinner, we're going to have dinner, and that's that. If you find yourself in those states where you're mentally just a little too extreme to one side or the other side, it can be really dangerous. So that one is probably the most difficult, is the internal state, the internal conditions to really hone in and figure out. Instead, what you really want to do is find that well-being balanced state, and that's where you ideally want to be. So looking at the market, you got the timing conditions that you're looking at because you're holding that stock for a certain period of time, just like the road conditions or your driving conditions. So you're looking at how long you're going to drive for. So if you're driving from Florida to California, then your holding time is probably a long time. So you need to make sure you're looking at longer time charts. Okay, if you're just driving from your house to the store, you're a shorter time frame. So the same thing in stocks. You're looking at a shorter time frame, okay, as far as making your big decisions. But you still want to take into account the weekly, the monthly, because you still want to understand. You still want to understand what's going on. So you still want to know, okay, well, are there other things that could create problems? So with the external conditions, this could be like hazardous on the roadways. This could be like, the weather, the sunny, the cloudy, the rainy things. So you're always looking at those other things as well. And finally, the internal factors. If you're just completely in chaos, if you're just completely feeling down, if you're not at a nice, even mental clarity state, don't trade, okay? You want to be in a nice, well-being, calm state. That's when you want to trade. If you're overly happy, if you're overly sad, if you're angry, those are not the times to be trading or making trading decisions. A lot of times it's better to just say, whoa, I'm out, step back, don't do anything, shut the screens down and let your position sit. And oftentimes they'll either come back or, they'll bounce back or go. Or what'll happen to me, what used to happen was that I would get into a position and I get into this position and, if I got scared, it pulls back, then I get out of that position. And then all of a sudden it bounces the next day and I was perfectly fine. And that was just simply because of my internal problems. So those are some things that you really want to take a look at as far as conditions go. I didn't go in detail, in as much detail as I wanted to in all of these, because it's just a huge amount of topics and concepts to cover. But you want to do some more studying about the different time frames. Look at the different time frames as you're trading. Don't just look at the 5-minute, 15-minute, the hourly, or just the daily. Start putting in the weekly time frame. Start putting in the monthly time frame. Look at those things. Look at the external conditions. How's the market doing from the Federal Reserve, from the global standpoint? Should you be at these levels? Should you be at these higher prices, lower prices? Is a pullback healthy? Is it normal? Like the rubber band effect. What's normal? What's logical as far as from the big picture view? So if you had no rainy days for 50 days straight, it's probably more likely, more probable, statistically probable, that a rainy day is probably around the corner, okay, unless you're in the desert or something like that. But in general, you're looking at those things. What are those conditions, the other external weather conditions? Okay, what's the likeliness of those things happening? And finally, the internal conditions. So internally, how are you doing? Angry, stressed, happy, joyous, whatever it is. You're looking for a condition where you're a little bit more stable, content, where you have that well-being. That's ideally how you want to trade. So I hope this video was helpful. If you enjoyed the new video format, go ahead, give me a thumbs up, and that way I know that I can continue sharing videos like these. It does take a little bit more time to set these things up, but hopefully you got a lot more knowledge maybe by seeing me, by me sharing some things, and just visually with the hand signs get a little bit more detail in terms of the communication gap that we have through the internet. Thanks again for joining me. In the end, remember to do what you love, contribute to others, but most importantly, live life abundantly. And if you want to sign up to the newsletter, go ahead, click this button right up here. You'll be taken to the sign-up sheet, and then enter your name and email address when you get there, and you'll be subscribed to the newsletter. So that way you can get my news announcements as they are released, some free books, goodies, and other things of that nature. Thanks again, and I'll see you next time.